And welcome to your Global Markets Technical Outlook for December 2015, brought to you by helixtrader.com. And just before we get going, a quick disclaimer, of course, everything that you're about to see and hear is just for educational use only. Nothing contained in this presentation is a recommendation to buy or sell any financial instrument. Trading and investing in the financial markets carries considerable risk, and you should always consult the counsel of a licensed financial advisor before deciding if any investment is right for you. We'll kick off this time with a pithy quote from John Maynard Keynes, who says that successful investing is anticipating the anticipations of others. And that couldn't be more true in the market today as at any time. And that's really why I propose that we should all aim to have a rigorous statistical, systematic approach to the markets rather than just trying to guess which way the charts are going to go. Of course, it has been a very volatile time in the market lately. A lot of traders and investors finding it tough at the moment with a bit of direction or lack of direction, shall we say. So let's now just delve into the charts and see if we can find out where the markets might be heading over the coming weeks and months. It is the last one of the year, so starting off with the stock market, we'll take the what I'm calling the ultra long-term view, and this is a 115-year-long chart looking at the Dow Jones Industrial Average, and as you can see, characterized very much by these large sideways consolidation patterns interspersed with these large upswings between those consolidation areas. We've just been in one of those patterns lately from the late 1990s all the way up to 2013 when we had that breakout to the upside, and it does certainly look from this chart that we could be at the start of a run-up for this market, although I know it doesn't feel like that, or certainly hasn't this year at all, with certainly a lot of sideways consolidation and range type activity. But we do have the breakout, and we have to respect that that is a long-term bullish signal for this market. Zooming into the monthly chart, we can see on the S&P 500 here very much that large sideways consolidation, the breakout in 2013, the market bullish. We did have that large pullback, as we now know it was, back in August there, but the market has recovered in quite quick fashion back up towards its highs again, just sitting around about that sort of 2100 area of resistance at the moment. The market's still looking bullish. I mean, there's no sign of a topping pattern, you might say here. So again, we just have to look at the overall direction, and there's no question that it's up at the moment. Looking at the Andrews Pitchfork, just put across the monthly data, this has actually been working very well, just based on the last two major corrections this market had in 2010 and then again in 2011. If we take the 3 points from those two corrections and then project the Pitchfork forward, and we can see that the price action has been respecting the upper and lower tines, just getting a bounce off that lower tine through that August correction there, and it does now look as though the market, well, it's ran back up to the center line, just finding a little bit of resistance there, but this has been an excellent indicator to guide us to where the market's headed. And once again, there's no sign that the trend is breaking down there at the moment. The market's still very much on a path upwards. On the weekly chart, just using a simple trend line here to delineate the uptrend that we've been in, really from the lows of the financial crisis in 2009. Very well behaved trend. We did get that touch off the top end of the channel there, which was enough to send this market lower, and we just met support down there at that 1900 level. The market's clearly bounced, but still really stuck in that large sideways range between 1900 and about 2200 for now. So we may just find it consolidating a little bit more before it gets enough power to get above that, but certainly no sign of a breakdown unless we get back down to that 1900 level, which seems a low probability outcome at the moment. On the Ichimoku chart, well, I guess I mean I would call this respect of the cloud. What we've just had here, as you can see, back in 2011, we had something similar where price projected through the cloud, although the lagging line never did. Remember, the price and the lagging line need to go through the cloud for a confirmation of the change of direction. But we remained bullish. We have had a penetration of the cloud once again, but the green lagging line, as you can see, still well above the cloud at this point. So nothing to see here, I guess, is the summary, and that support projecting forward around about that or just below 2000 there, about 1980, let's call that. So we've got some support there continuing from the cloud, projecting forward into the future. So bullish remains. The market remains overall bullish on the Ichimoku. Nasdaq 100, I thought it was important maybe just to throw this chart up because we're now just starting to make a test of the all-time highs in the Nasdaq, which were back in the dot-com boom of the late 1990s, just early 2000 there. We had that peak up at 4,800 and just approaching that. So the Nasdaq's been very strong, as you can see, all the way from 2009. Well exceeding its 2007 peak early on in the piece, around about 2011. So this is I think this is bullish for the overall market. Technology being a riskier sector does tend to lead the market. So as long as this is drawing in capital from the sidelines and people are willing to bid this market up, then I think that's one positive tick in the box, if you like, for the overall wider market, such as the S&P 500. So let's have a look now at the market fundamentals, and we'll just see what the health of the underlying market really is compared to what we can see on the price charts. We'll start off with the case for the prosecution, if you like, and what are the red flags really that are worrying us about the current state of the market. Well, the first one here is the Dow versus the transports. I mean, this is probably one of the oldest relative strength measurements thought up by Charles Dow himself, I understand. So we can see here that the Dow Industrials and the transports were making good ground earlier, well, for the last 2 years really, through 2013, 2014. That meant there was a positive spin on the relative strength measurement, which is just one divided by the other. That was a healthy sign for the overall market. We want that. We want the relative strength. In other words, the transport's just outperforming a little bit the industrial average. Lately, we've seen the index turn sideways, and the transports have not managed to make as much ground, and so we're seeing that that relative strength just diving down there, and so that is a little bit concerning for the overall market. Once again, the transports tending to lead the overall index, so that's a small concern, I guess, for the state of the index at the moment. And on the market breadth, these also of slight concern. We've got the market has recovered towards its highs, but here you can see that when the market breadth recovered out the bottom of that correction, didn't quite get as high as the previous highs had been. So currently only 59% of stocks in the S&P 500 are bullish, which is, you know, just a bit more than half, obviously. So that's a little bit of concern. We would really want to, if we want to break into new highs on the index, we need this market breadth to start pushing back up into the 80s and the high 80s if possible, something like it was back in 2013 when the market was taking off. So for now, this probably means that we're in for a bit more consolidation, sideways action. That certainly doesn't point to a bear market as such, but it's certainly not overall strongly bullish at this stage. This is another market breadth indicator measuring the percentage of stocks above their 200-day moving average, and you can see this one's actually slightly worse. We did get that sort of leveling or falling, if you like, in the peaks as the market was rising, which gave us a bit of divergence, indicating there was a correction coming. We have had the correction now, but as you can see, currently less than 30% of stocks in the S&P 500 are above their 200-day moving average. So that is a little bit concerning. Once again, that probably means that we're not ready to push into new highs just yet, and we would really need many more stocks to be participating in the uptrend for that to happen. This is a look at this S&P 500 and comparing it to its price earnings range, and here we've got the green line, the blue middle line is the fair value, around about 15 PE. The red line is about five above that at 20, and 5 below that is the 10, which is called undervalued and overvalued, I guess. As you can see, that at times in the past where we've come up to that sort of overvalued level, it has been times when it has caused a little sell-offs. There's the 1987 crash, Black Monday there, and just sort of nudged above that overvalued line and then sold off. We're currently really sort of nudging against that line at the moment, so we are sort of overvalued in terms of PE at least. But if we look back to what happened in the bull market of 03 to 07, you can see that we did extend well above that before there was any sign of a top. So it doesn't necessarily mean that there's going to be a major sell-off just yet. But it is a warning sign towards the top in 2000. I beg your pardon, that earlier one there is 1999. This one here is the 2000 top, and where it was just nudging that before the sell-off. So more often than not, it does create a sell-off, but as you can see, it can swing way above that, as it did through the 90s there in the dot-com boom. On the downside, of course, each time it gets down to that lower value level, it has kicked higher, but even through the financial crisis, it never really got that low. So I guess the takeaway is that the market is overvalued here, but that does not necessarily mean we're in for a large correction at this stage. So let's look at the case for the defense, I guess you might call this, and these are the market. These are the charts that are telling us that the market is actually overall healthy. So we've got, first up, we've got the Nasdaq 100, as we've already pointed to that already as being very strong, and as you can see here, it is relative to the S&P 500, and it is outperforming the S&P 500. So once again, that's a positive sign. We want the Nasdaq to be leading. If the Nasdaq started to underperform the S&P 500, that would be a definite red flag for us. But at the moment, there's no sign of that, so it's steady as she goes. And we'll have a quick look at the yield curve. And if you didn't catch last time's presentation, or you want a quick reminder, here's a quick primer of how the yield curve works. So these are some charts from historic market conditions, and on the left here we've got the yield curve, which measures the interest rates between short-term bonds and long-term bonds, going from short-term on the left of a few months up to longer-term 30 years on the right, and we've got the interest rate up the left-hand side. At the market top in 2002 here, we saw the curve very flat and inverted. So in other words, the interest rates, short-term interest rates, were at least as much and a little bit more than the long-term interest rates, and that's a sign that it's turning into what's called a risk-off environment. People are pushing money into bonds because risk is high in the market, and that led to the bear market that we saw after the dot-com boom. In 2003, once the market started to recover, short-term interest rates fell dramatically, and we ended up back in this more what I would call normal-shaped curve, where the very short-term interest rates are very low, and the long-term interest rates are high, and so we end up with this sloped low to high curve. This is showing us risk is low, market conditions are normal, and we're usually in a bull market, as we did go through in 2003 up to 2007, where we ended up once again in that very risky environment as the market got to the top. Short-term interest rates ballooned, and we got once again we ended up with that flat yield curve, as we can see here. That was indicative of a risky market, money flying into bonds out of stocks, and that caused the sell-off. Then in 2009, it's the same pattern once again. The short-term interest rates fell, and we ended up back with this slope. So the takeaway is that market tops will tend to happen when the curve is flat or inverted. Bull markets will tend to persist as long as the curve is in that sloped low to high sort of formation. So the question is, what is the slope looking like? What is the yield curve looking like right now? And on the next slide, we can see that. So we've got the market here, which, is at these giddy heights at the moment. And, some people might think, well, it's come a long way. Surely it must be near a top. But as we see from the yield curve here, we've still got this very low to high sloping, which tells us that risk is low in the market and bull market will persist as long as this shape carries on. Now, there's obviously this is all based on US interest rates, of course, and there's talk there at the moment that we could be seeing an interest rate rise soon. Now, they're talking about 25 basis points, which is not very much, that's quarter of 1%, so that's not really going to have a huge effect on this curve, and, it may take a number of years for the shorter term interest rates to get back up to that flat or inverted shape. So, so for now, it's highly unlikely that we'll get a bear market because this is the shape of the curve. There's just, the money is just not flowing into bonds at the moment, and so while we need to monitor that, it's certainly telling us that there's no cause for alarm, certainly not at the moment. On the sentiment indicators, this is another benign one at the moment. As you can see, this moves. This measures the ratio of calls to puts in the market, or puts to calls, I should say. So when there's far many more puts being bought, the ratio rises, telling us that people are more bearish. When there's many more calls being bought, the ratio will fall, and you'll tend to get turning points at these extremes. But as you can see at the moment, we're just right in the middle of the range here. Yes, it's pointing a little bit up, but that can change quite rapidly. The correction there in August did get us very close to that so-called bearish extreme, but never really sort of pushed into it. So this is very much benign and situation normal. If we did get up above this green line into the sort of the high 0.7s or towards 0.8, that would start to be a cause for concern. But we're certainly not there at the moment. So once again, there's no cause for concern with this chart. And on the VIX, the so-called fear index, of course. And this is another one that's fairly benign at the moment. The VIX will tend to move in three zones, if you like, and we've got the sort of that sort of 10 to low 20s zone, which is the very much risk is low, volatility is low, there's complacency in the market, if you like. People are not concerned that there's much risk around, and so where we are, we're obviously still in that range at the moment, which is good. The up into the sort of from the low 20s up to about 40 is what you would call the sort of medium risk range, and we did obviously push into that area when we got the correction back there in August. And then above 40 is the sort of extremely high risk area. That's where we were getting readings during the 2008 financial crisis, of course. We did get this one spike back here in August, but that was clearly an anomaly. There was no reason for it to go up that high. I think what had happened is we hadn't had a correction in the market for so long, and people just got completely spooked and threw the baby out with the bathwater. But quite quickly realised that that was an anomaly, and now with the VIX is back now here in the so-called normal range. So I think as long as that stays below the low 20s, then we can be reasonably comfortable that things are okay. And once again, this is a very benign reading and positive overall for the market. And just rounding up from the US stock market with a quick look at the cycles. This is the Dow presidential cycle. Here we're currently in a pre-election year, as I'm sure we know from the news coming out of the US. But interesting that the chart is clearly not what we've had this year. We've just basically had a very large sideways pattern all year. I mean, the market's gone almost nowhere since the start of the year. But the second half of this chart, I think, is more realistic to what we have had. We have had that sell-off in August, maybe came a little bit early. We didn't get the bounce as much there. Perhaps it was a little bit late in the cycle. But we're right here where the green arrow is now, and who knows whether we might just get this little possible Santa Claus rally towards the end here that would pop us back up into new highs. I'm not sure, not so sure that's going to happen. We may get something, we may not. Who knows? There's obviously an interest rate decision coming up in the US, and that may have an effect one way or another on the markets. And I think we'll probably just be chopping around till that happens, and hopefully we'll get some direction after that. Of course, it is an election year next year in the US, and so let's have a quick look into the cycle chart for that year. And as you can see, it's starts off fairly choppy until about the middle of the year, where it finally gets some direction. So the thing to always remember with cycles is they are just a summation of what's happened in the past. There's certainly no guarantee that that's what's going to happen next year or any year for that matter. So we need to take them with a little bit of a grain of salt, but you know, often they will have a tendency, and that's really all we can say. So we'll keep an eye on this one as we go through next year and see how the market actually lines up with that. So just summing up the US stock market, of course, we've had that long-term bullish breakout from the sideways pattern in the 1990s to 2000, well, mid to 2010s, I guess you would call them. So we've had the breakout from there, and then the market now looking long-term bullish for now anyway. Although as we've seen, momentum has plateaued, certainly this year, and we've had a loss of momentum, and the market has just been grinding sideways. So it's been a little bit frustrating for a lot of people, but hopefully we'll get some direction out of the market soon. As we can see, the fundamentals remain largely either benign or positive. We are seeing a few shorter term indications that are weaker, such as market breadth, and that's probably going to hold the market back in the short term at least. But my sense, my analysis, if you like, overall is that this sideways consolidation will eventually give way to further upside, and we'll have to wait whether that's next week or next month or next year. We'll have to wait and see, but that's certainly the probabilities will favor the upside, I think, rather than the downside. The levels to watch, we've got resistance up ahead, that's sort of around about 2150 level, and support below at around about 1900. So those are the levels to watch on the US stock market. Flicking over to the local market now, and as we can see on the monthly chart here, it's make or break time for the ASX 200 at the moment. We've pulled way back to that 5,000 level, and we're just at the confluence of the ascending triangle there, where the apex intersects. So whether that provides enough support for this market to give it a lift, we'll have to wait and see. But 5,000 is obviously a very key level for this market. It's been touched a number of times from the underside and the top side, and so we're really at a critical moment in time for the Aussie stock market. Zooming into the weekly chart, we are seeing this, what I'm calling a possible inverted cup and handle, or maybe left shoulder and head. It's obviously too early to tell whether this is any sort of topping pattern. My feeling is that this level will probably hold for now, but I could be proved wrong in quite short order. So again, we'll have to see. And if we do lose 5,000, we would be looking down towards that 4,600 level is the next sort of reasonable area of support, which is obviously a fair distance down, and that would be quite a significant move if the market managed to lose 5,000. Clearly, it's had a great run up through sort of 2012, 13, and 14 anyway, when it managed to break out of that 5,000 level. So that really it has made it a critical level, and a lot of eyes will be watching that psychologically significant round number at the moment. On the Ichimoku chart, well, the decision has already been made on this chart that we're clearly through the cloud with price, we're through the cloud with the lagging line, and that blue dotted line there marks the spot where the market turned bearish, so just about here, and then we've come up, we've tagged that level where we found resistance, and the market's moved off south again. So it's not looking great at the moment, certainly not on this chart, and this is binary. It's either bullish or bearish, and at this point it's bearish. There's no question about that. So we would really want this market to get back above where the cloud is now, around about that 55-60 level. That's where this market needs to get back to in order for it to turn bullish once again. Having said that, this cloud will now start to follow the market down, so that level will be increasingly lower, making it perhaps easier for the price to regain it if and when it can. But having said that, the market may be looking torrid or even bearish, but there are still a couple of shining lights. If your system's good enough to pick them up, these are a couple that the system that I run picked up. Blackmores didn't pick it up down here at 32. This is just pointing out what it's done this year. But it's had a great run, this stock, all the way from 32. Just got up there, tagged 200 briefly, pulled back, but it now looks like it's heading for that 200 level at the moment. So it's there are gems to be found in the stocks if you know where to look. Blackmores is obviously one of them. Another one that my system's picked out is this Bellamys one. Again, down the start of the year here, just $1.69. It's gone up to $13. So it's had a great run as well. Just showing a little bit of a profit taking, I think they call it in the business, just at the top there. So we'll wait and see. But I mean, clearly the trend's up in here, and there's these are a few. These are a couple of quite a number of stocks that are running at the moment. So it's best to sometimes not just concentrate on the index itself, but to actually have a look at the underlying stocks and see where the momentum is actually laying. So just to summarize that, ASX 200, we are really at that make or break point. We've got critical support at that 5,000 level, and we've tested it, over and over and over again, and like banging a hammer against the wall. Eventually it's going to go through, but maybe not. Who knows? We may get some support coming into the market. Who knows? End of the year we might get a little bit of a run off it, but it's really a make or break time for this market. And if it breaks through, then 4,600 is going to be the next level to watch out for. And as we've seen, there are still bullish stocks around, so it's best perhaps not to have your money in the index, but instead to have a dig around and see what stocks are good out there. Switching over to the currencies now, and the local currency first, the old Aussie dollar. And well, I mean, these I haven't really changed the lines on this chart since the last time I showed it. That 70 line came down and respected it, found a little bit of a bounce. It's now heading back up, of course, but for how long? I mean, clearly there's a lot of momentum behind this downtrend here. So we may see it go back up and tag the uptrend line here around about 75, 76. But it would be a very surprise if this was the actual bottom. It just doesn't look like it's done enough work to turn itself around. I'm sure we're going to see, back here there was a lot of consolidation of 5 or 6 months of going up and down, large swings. That we need something like that to turn it around, either that or a large piece of consolidation like we got at the top here. So 3 months does not maketh a bull market, that's for sure. So this currency still very much bearish, although it has had a bit of a kick off that 70 level. So we have to respect that in the short term. On the euro, well, there's no question that this one is having quite a tough time at the moment. But the ECB are doing their best to try and pump money into the European economy, and there was, we did get a little kick up here on the euro as the pundits, I guess, didn't like Mario Draghi's latest attempt at quantitative easing. They thought he could have gone a little bit further. So the hawks coming out to play a little bit there, and we're seeing a bounce here. Just on a pure technical basis here, I still think we might get a retracement up to tag this $1.20 line here. and before the next leg lower, or or some sort of sideways consolidation at that level. I certainly can't see this heading north at the moment, but that we would expect, after such a severe breakdown of quite strong support, that we would get a retest. So my money's still on a bounce back to that $1.20 area. On the British pound, nothing much to write home about here, just still stuck in that sort of $1.70 to $1.45 area, just heading really sort of sideways, tracking sideways in that range. Probably would make for quite a good range trade if that's your thing. Certainly a lot of these FX love support and resistance. They love sort of that range type of trade. So if that's your thing, then the pound might be one to watch while it remains in that pattern. On the yen, well, this is looking quite tragic, of course. Although, having said that, we did just consolidating a little bit down here at that 80 level. So who knows? Again, this is going to have to do a lot of work before it can turn itself around. And the Japanese central bank also pumping money into the market like it's going out of fashion, so that's not going to help the currency overall. The exporters of Japan obviously love it, but it's not great news for if you're a long side investor in the yen, that's for sure. And the US dollar, well, this is the sort of the strong one in the pack, really. This is sort of, I guess, pushing everything else lower because most things are paired with it, or they have a heavy weighting in the US dollar in the indexes anyway. But clearly this is on a bit of a tear at the moment. Yeah, we had a bit of a pullback there with the ECB news, but still, there's no damage done to the uptrend that I can see. We've got strong support there around about 93. 103 is up ahead. That actually goes way back, that line of resistance, so it's probably quite weak. And I think once we spend a bit of time sort of trying to digest what happened here back in 2014, that we'll probably get another leg up. Again, we might even get to the repeat run of this, so certainly up into this area would be no surprise. And the US dollar still looking strong. And just rounding off on the commodities now, the Goldman Sachs Commodities Index, and this is obviously quite bearish. Commodities very soft across the board. There's no real bright spots on the long side with commodities at the moment. This index has obviously been, the index itself is quite heavily weighted in energies anyway, so you can guess the effect of oil is having on this. But even still, we're down back at the sort of financial crisis lows around about 305 there. Again, there's no sign. I mean, it's still the proverbial falling knife at the moment, so I wouldn't be wanting to try and stick out a long position to try and catch it. This needs to do some consolidation work before it's going to turn around. But this thing can turn around quite quickly, as you've seen at the tops and bottoms here. So we'll just have to wait and see. But 305 is the next line of defense, if you like, and after that, then we're way back to the sort of the 2003 lows down here, which would be interesting, I guess, if we got down that far. Here's the smoking gun in the commodities world, if you like. This is the oil, which is just having a disastrous time at the moment. Can't catch a bid, as they say. Fell out of the symmetrical triangle pattern, just walloped straight through that 70 support level there, and it's just sort of hammered down. Got a brief respite. I remember around about here, there was a lot of people who thought that oil was a good long at that point. I wasn't so sure, but it's actually turned out to be a rather good short since then. Just heading down for 33. I mean, it's at 37 at the moment, so oil below $40 a barrel, and heading down to the 08 lows around about that 33 or just below 33 level there. And one would imagine that there would be some support, certainly some demand showing up in that area just on a pure technical basis, but whether that's enough to arrest the decline, then we'll have to wait and see. Gold is also been a very nice short at the moment, and you know, the gold bugs are not having a good time of it at the moment. 1150, it looked like it was going to hold that area, and then it just fell through it. It looks like it's now heading for that round number support, which is the old sort of '07 highs, around about $1,000. If it loses that, then we would really be looking to the financial crisis lows back around 700. You know, while market risk is low, there's no real benefit in owning gold, and I guess that's what we're seeing the effect of. People are just dumping their gold, and it's driving the price lower. So not a good time if you're trying to be involved on the long side of gold, that's for sure. And then just finally, just to show you that it's not just energies and metals that are having a bad time, also the agriculturals too. This is soybeans, which a lot of people like to follow. You know, it's been in a massive downtrend since, well, I mean, you could trace it all the way back to the highs in 2013 there, but certainly lately it's been sort of trying to consolidate around about this 904 level, which has been sort of fairly decent support, but just lost that level lately, and now looks like it might be heading for again for the '08 lows, which was around about 780. So commodities across the board very weak, and nothing really to write home about on the long side there. So let's just sum all that up, and on the outlook for global markets, I guess we're seeing that while the stock indices are all in long-term uptrends, technically we are seeing some weakness, and I think consolidation is probably going to continue for a little while. You would have to say the probabilities still favor the upside, but as and when that's going to happen, we have to wait and see. As we can see on the currencies, most of them fairly weak or just consolidating, such as the British pound. US dollar is obviously the shining light here. It's strong and remaining strong. Obviously, people are starting to get bullish on interest rate rises now, so we're starting to see the effects of that carry trade, where people are long dollar and short just about anything else really. Commodities still remaining weak across the board, as we've seen as well. So it's a real sort of mixed bag. There's not a lot to sort of hang your hat on there, but hopefully 2016 will be a much more positive year, and we'll be able to see a few more things happening in the market. So just to round that off, if you're not aware of me already, or you're seeing somebody's passed you the link to this video, then feel free to get in touch. You can have a look on the website there, helixtrader.com. Recently featured on Better System Trader podcast. If you're not a fan of that, I'd highly suggest it. If you're into any sort of systematic trading, or you'd like to get involved in systematic trader, then his podcasts are well worth a listen. But by all means, have a look at helixtrader.com. Plenty going on there, and you'll see all the descriptions of the elements that are listed there: trader coaching, systems, and system development training. Happy to have a discussion with any or all of that with you, or if you have any questions about this presentation, then feel free to drop me a line there at alan@helixtrader.com. And with that, I wish you good trading and Merry Christmas, Happy New Year, and all the best for 2016. Goodbye.